Good afternoon, buon pomeriggio, and welcome to the second symposium of this EA Congress, whose title is Integrated Reporting, Achievements and Challenges from a Multi-Stakeholder Perspective. My name is Ariela Caglio. I'm an associate professor of management accounting within the accounting department of Bocconi University, and I'm going to chair this symposium. As I am myself doing research in sustainability and non-financial information and integrated reporting, I'm very excited to introduce three prominent speakers on these topics. Mary Barth, Stanford University, Richard Barker, University of Oxford, and Brad Monterio, Colgan Group and Institute of Management Accountants. Let me take this occasion to warmly thank them, and also to thank IMA, the Institute of Management Accountants, for generously sponsoring this symposium. So what are we going to do in this 1 hour and a half? So we're going to problematize integrated reporting. That is the latest international attempt to connect in one single document a firm's non-financial and financial disclosures. NIR is meant to provide an organization value creation story and to stimulate businesses and managers to use integrated thinking in order to reflect upon how they use a whole range of different factors, including financial, manufactured, intellectual, human, social, relationship, and environmental resources in order to create value in the short, medium, and long run. It's quite a novel form of corporate reporting, and therefore there is not a definitive view on IR, nor definitive results. So my role as a chair is very easy because I'm going to put up some issues, some question marks, and I will leave the task to provide you with some answers to our panelists, or maybe with additional puzzles. So I think that the integrated reporting is a very intriguing area of research because integrated reporting is a multifaceted concept. It can be many different things at the same time. So integrated reporting is perfectly in line with the recent development of financial and non-financial reporting. So companies are using integrated reporting in order to disclose non-financial information. So in this sense, it is similar to CSR and sustainability reporting, but it has been said to be different because the essence of integrated reporting is to connect previously disconnected pieces of information, of financial and non-financial information, of qualitative and quantitative information. And therefore, integrated reporting is meant to tackle, to solve some issues of standalone sustainability reports, such as, for example, the fact that they do not account for all the sources of value creation. They do not clearly communicate an organization business model, and most importantly, they do not explain the complex interconnection among non-financial sustainable performance and financial performance. Integrated reporting is also a very interesting setting because around the world is part of voluntary disclosure. So companies are adopting integrated reporting in different regions at different speed rates. And it's going to be very interesting to monitor the developments in Europe given the recent EU directive on non-financial information. But integrated reporting is also a form of mandatory disclosure in South Africa. Since 2010, listed companies are using integrated reporting on an apply or explain basis. Regarding the users, the framework, the IR framework, clearly identifies investors as the primary users of integrated reporting, but it also recognizes the importance of the different stakeholders. So it also recognizes the fact that a company depends on a whole range of stakeholders in order to create value. The purpose of integrated reporting is, of course, to provide a clear and concise picture of a firm performance and activities by connecting material information regarding an organization strategy, an organization governance, an organization business model, and of course, an organization financial and non-financial performance and prospects. So the aim of integrated reporting is to provide a more meaningful, a clearer picture of the activities and performance of an organization. But it's true that recent research has found that managers use integrated reporting in order to implement impression management strategies. So especially when the financial performance of the company is weak, managers put in place obfuscation strategies using a combination of quantity and thematic content manipulation and reading ease and verbal tone manipulation. Definitely, integrated reporting is more costly than traditional financial reporting. The issue is whether the adoption of an integrated report is going to bring benefits to companies, economic benefits, but also non-economics or intangible benefits. And according to the IRC, these benefits are external benefits because with integrated reporting, companies are going to improve the dialogue with capital markets. But these benefits should also be internal because through integrated thinking, integrated reporting is going also to improve the decision-making processes of managers. I left this puzzle, this issue, as the last one, because during this symposium, we're going to focus exactly on this, on the achievements of integrated reporting, but also on the challenges. And it's clear that IR quality is a trigger of the aforementioned benefits, but quality and IR quality in itself is a challenge. First of all, what is IR quality? It's not easy to define what quality is. It's a challenge both for academic research, but also for practitioners. So if you think about quality, it's difficult to operationalize, to measure quality. Different approaches have been proposed in terms of content analysis, of scores, of computer-based textual analysis, but there is not a definitive answer on this. And also from the point of view of practitioners, companies are trying to understand how to improve the quality of their IRs. So starting from these issues, our panelists are going to explore the achievements and challenges of integrated reporting. And I will leave the floor to Mary, who's going to talk about the association between IR quality and IR benefits, both in terms of market effects and real effects. Then Richard is going to problematize the concept of IR itself. And Brad is going to talk about the opportunities and challenges that companies are facing while implementing integrated reporting and while trying to improve the quality. And he will talk about reliability as an important dimension of IR quality. So please, Mary, the floor is yours. Thank you.
Is this microphone on? Okay, good. I'm going to use this one. Thank you, Ariella. Ariella asked me, I'm delighted to be here to talk about this topic with all of you, and I'm anxious to hear your comments. Ariella asked me to start out by talking about a paper that I have on economic consequences associated with integrated report quality to sort of set the stage for the conversation that follows, and she's got us in a particular order, so I'm the lead off, I'm setting the table. So I don't have many answers. I just have one paper to share with you. So this is joint work, Stephen Kay and Lily Chen and Elmar Venters in AOS in 2017. As you know, and Ariella just explained, integrated reporting has an objective to explain to providers of financial capital how an organization creates value over time. That's the main objective. And the focus of integrated reports is on, you guessed it, integration. And the idea is to integrate strategy, governance, performance, prospects in the short, medium, and long term. This focus, combined with the objective, has led to the dual objective of financial reporting to both improve the quality of information to outside providers of capital, to enable them to make more efficient capital allocation decisions. Can you hear okay with the echo? Is it all right? Okay, we're getting an echo up here, and it's a little bit harder. As long as you can hear, I'll try to ignore it. And the second prong is to promote integrated internal decision making. And the idea is that if you have better integrated internal decision making, you make better decisions, and hopefully that translates into more value and everyone is better off. That is the idea. And there is no, it's a framework. It's not a set of standards. Having served on the ISB, we write a lot of standards for the financial reporting part, but I don't know whether we'll never get there with integrated reporting, I'm not sure, or whether the plan is to do that. But at the moment, it's a framework, and there's a lot of judgment involved in what goes into the report. All of you who are familiar with integrated reporting have probably seen this diagram. The focus of integrated reporting is on 6 capitals: financial, manufactured, human, intellectual, environmental, natural, and social and relationship capital. Financial capital is just one of the 6. That's where I focus most of my career. But there are many other things that go on inside the firm, and that's what this is about. And the idea is that the business model of the firm takes all of those capitals and does whatever it does in its business model, and then has impact on the outside, and all of these things have impacts on each of these capitals. Notably, it's not limited to CSR either. It's broader than that as well. CSR, I think, is in here, but it's not the total focus. It's integration of all the capitals that the company has at its disposal. So with respect to the paper, the motivating question for the paper is, does high-quality integrated reporting facilitate firm management and investor understanding which manifests in economic benefits to the firm? I call it a motivating question because that's the big question I would love to have the answer to. Not possible to answer in a research paper, but that's what we're headed, and therefore we ask some specific research questions to at least get some evidence towards that motivating question, even though we can't answer it directly. So the first question we ask, is higher quality integrated reporting associated with capital market effects, higher firm value? Now, there's prior research before this paper that has shown it's associated with higher firm value, but we go on to look at greater liquidity, higher expected future cash flows, lower cost of capital, greater analyst target price forecast accuracy. So this is on the financial side. How is integrated reporting, higher quality integrated reporting, affecting some of these capital market measures? And then on the other side, on the internal decision making, we try to look at some real effects, and particularly look to see whether higher quality integrated reporting is associated with higher realized operating cash flow or greater investment efficiency. So as you notice, the capital market affects his expectations about cash flows, but then we look to see whether it's associated with higher realized cash flows. I have to say, when I began this project, I was a bit of a skeptic. Sorry, those of you who developed this framework, but like many times when I do research on things that I don't understand completely. And this was a case with integrated reporting. I'd heard about it. Everybody's talking about it. I didn't know much about it. And I spent a lot of time trying to learn about it in the context of doing this paper. And I was impressed with what we were able to find. So some of these reports, when I looked at them originally, they looked like marketing documents, a lot of glossy pictures, a lot of charts. But then when you look at them more closely, you will see that those charts and those glossy pictures tell a story that makes the communication of what's going on inside the firm better. In terms of firm value, we look at Tobin's Q. Liquidity, we look at bid-ask spread. Expected future cash flows, we look at target price forecasts. Cost of capital, we use the average of the standard cost of capital measures from research. And then investment efficiency is also from prior research to look at residuals of one-year head investment on industry sector sales growth. And we look at both levels and changes. As Ariella mentioned, South Africa is the only country, at least that I'm aware of. She said it too, so I guess it's still the case. South Africa is the only country in the world that mandates integrated reporting, and so that is where we focus our efforts. Mandatory setting helps us avoid, from a research design perspective, all of the incentives that are involved in involuntary reporting, and also gives us a bit of a bigger sample size. South Africa also has lots of experience in integrated reporting because it was voluntary before they made it mandatory, and then it's been mandatory for a number of years. Well, it was voluntary since 2000 and requires firms listed on the JSE since March 1st, 2010. The rule there is apply or explain. That's what they mean by mandatory. So disclosure about integrated reporting is mandatory, which means they can meet this requirement by issuing an integrated report or by other means. And it turns out that about 97% of our sample identifies the report as an integrated report. If they don't issue one of these reports, they have to explain why they didn't do it. That's what it means by mandatory. They either do it or tell the exchange why they didn't do it. And if you're telling the stock exchange why you didn't do it, you better have a good reason, which I guess is why virtually every firm does it. They adopted the IIRC framework in 2014. We use the largest 100 firms on the Johannesburg Stock Exchange in terms of market capitalization from 2011 to 2014. We do that, in a minute I'll talk about the quality measure that we use, and that's why we use the largest 100 firms. So the data for most of our tests come from the usual sources, CompuStat, IBIS, Reuters Asset4, DataStream. The key when you're looking at report quality is how do you measure quality? And a lot of people have done different things, look at indices of the extent to which the firm complies with the framework, this sort of thing. We're able to use the scores from Ernst & Young's Excellence in Integrated Reporting Quality Awards. So every year, and they've been doing this for a number of years, well, since 1997, evaluating the quality of integrated reports. And there's 3 professors at the University of Cape Town who have been doing this for a long time. Same people throughout our sample period, as this says. They read these reports. They spend several hours on them. We talk to these people. They don't just say, is this here, is that here, is that here? They read it and try to figure out whether the report, in their view, is high quality. And to them, high quality is really embracing the principles and the content elements of the framework, and not just having glossy pictures that don't fit together to tell the story that they should be telling. That's one reason that we are able to, we take their scores because they spend a lot of time doing this. And they do this for the largest 100 firms on the Johannesburg Stock Exchange. They describe their scores. You probably can't read this, but they give up to 10 points for each of the guiding principles, which are strategic focus and future orientation, connectivity of information, stakeholder responsiveness, materiality, conciseness, reliability and completeness, consistency and comparability, and for the content elements, which are organizational review and external environment, governance, strategy and resource allocation, opportunities and risks, performance, and future outlook. They also give points for the framework's fundamental concepts of explaining the business model and how value is created, and integrated this discussion throughout the document. We have, Ernst & Young puts companies in 5 buckets and gives an award every year for the firms in the top bucket. That information is publicly available. we were able to obtain from Ernst & Young the component scores for each of the content elements and the guiding principles. So we actually have the score sheet, which enables us to not only do the analysis of the outcomes that I told you about, but we can see where it's coming from, what parts of the report seem to be more important than others. So what do we find? We find firms with higher quality integrated reports have higher firm value, greater stock liquidity, higher expected future cash flow. We don't find anything for cost of capital, which also is consistent with prior research that's looked at cost of capital. So these are the capital markets effects. With respect to higher future cash flows, expected cash flows, we try to figure out whether it's expectations or real. And so the first thing we look at to see is whether it's associated with lower analyst forecast error, and the answer is no. So, and then we say, is it associated with future realized cash flow? And the answer is yes, yes in the sense that we find a significant relation. We also look at over and under investment. We find more efficient investment. Both over and under investment is mitigated. So it's not just on one direction. And those are the real effects that we document. And with respect to the content elements and the guiding principles, we find that connectivity, stakeholder responsiveness, and materiality and conciseness are the most consistent drivers of these findings. And the connectivity is important because this is about integrated reporting. And it turns out that when we look at the content, these content elements and guiding principles, it is connectivity that comes out scoring pretty high in terms of being associated with these results. So to conclude, we provide early evidence on the association between integrated report quality and various economic outcomes. The evidence suggests, the way we interpret the evidence is that it suggests better internal decision making, so these are the real effects, and that ultimately translates into higher equity values. There's much more to do and learn. This is just a first step, but it seems that I'm now convinced that integrated reporting has some positive economic consequences and probably worth spending some time learning more about it and doing more research about it. So, thank you.
Richard is asking a very fundamental question, and in his presentation he's going to problematize integrated reporting, and the central question is, what is an IR? And he will talk also about this idea of a multi-stakeholder perspective. So I will leave the floor to Richard. We will have a Q&A session after the 3 presentations, okay? Thank you, Richard.
Thank you. So we're getting a strange echo back here, which means that the people on the stage can't hear what each other is saying. So I've no idea what Mary just said. I'm sure it was good, because Mary is Mary. I could say it's not, because she wouldn't be able to hear me, but anyway, but you can hear me okay, can you? Okay, good. All right, so my task here is to contextualize integrated reporting a little bit. And so various thoughts in that regard. Firstly, just picking up on Mary's paper, it seems to me that it's timely in some sense, but also early for empirical research in this space. I think it's really a great thing to see Mary engaging in this space. It kind of represents the mainstreaming of integrated reporting, of non-financial reporting into accounting research, which is a great thing. On the other hand, it's not entirely clear as yet, for reasons that I'll talk about, quite what non-financial reporting is, actually, what integrated reporting is, and therefore quite what it is that's being tested. So we're at the very early stages, I think, both of the ability to do empirical research and of the conceptualizing and theorizing of what it is that we're doing. So there's a rising trend in non-financial reporting, of which integrated reporting is a part. This trend is important. It's clearly consequential. That we understand the impact of corporations on the environment and social capital and so on. However, this space can be characterized as emergent. integrated reporting is vague in its method, in principle how you're supposed to do it. It's inconsistent in practice. So if you look from one company to another, or you look at non-financial reporting in general from one company to another, it will be inconsistent. It's also non-financial reporting in general, to a degree, is unclear in purpose. Integrated reporting is clearer than some other aspects, but you don't need to scratch the surface very much, even with integrated reporting, to realize there is a degree of confusion, for example, about the role of the stakeholder and the extent to which the stakeholder is important or instrumental in this world. Okay, so there's some evidence on the rise of non-financial reporting. This is from GRI database, and it just shows the multinational enterprises doing sustainability reports over a 20-year period, and you see a dramatic increase. It's now the norm for large companies to issue either a separate standalone sustainability report or something that's integrated with their annual report in integrated reporting fashion. But this is a thing now, which it wasn't not all that many years ago. I've tried here to do a sort of taxonomy of different approaches to non-financial reporting, to locate integrated reporting, but also to give some structure to the space. I'm sure you can think of different ways of doing this particular representation, but the idea here is basically to say, look, you start with a question which is, are you reporting primarily to shareholders or not? And if you go down the reporting to stakeholder route, you end up with GRI being the predominant supplier, as it were. And if you go down the reporting to shareholders route, you end up with a lot more activity going on. So within the shareholder route, a question is, are you reporting primarily through financial statements, or are you providing information that is supplementary to financial statements? If you just take the financial statements route, another question is, do you report just on sustainability or not? And that's where you locate IFRS, right? So IFRS is shareholder-oriented, financial statements are the focus, sustainability or integrated reporting or ESG or whatever you want to call it is some separate domain. You could, in principle, this is very rare in practice, you could, in principle, have a form of financial accounting that monetizes and integrates the non-financial activity. So you could, for example, have the cost of environmental impact added to the financial accounts to give you a sort of bottom line metric, as it were. That, in a sense, would be true integrated reporting. But we're nowhere near doing that. So integrated reporting actually is a separate reporting of financial and non-financial. So this is the most populated space, as you can see. And there are various organizations that are all offering some sort of framework or some sort of way of thinking about how to report to shareholders with respect to not just financial performance, but broader performance. Okay, so that's the domain. What's IR within all of that? Well, it's this. And Mary's already shown this slide. And I know that because this is cut and paste from her presentation, but she can't hear me, it's okay. But that's basically it, right? That is integrated reporting. There isn't more to it than that. It's a description, it's a concept, it's an idea, right? If you compare integrated reporting with financial accounting standards, the difference in the level of granularity is pretty striking, to say the least. And underneath the surface, I think it's important to be clear that financial accounting, as we know it, and integrated reporting, as it's emerging, are fundamentally different things. We talk financial capital and natural capital and social capital, but actually, as an activity, integrated reporting is different on every important dimension, I would say. So accounting is commensurable, everything adds up. In integrated reporting, it doesn't. Accounting is evidence, transactions-based. Integrated reporting allows much more scope for estimation. Accounting is complete in the sense you've got a complete set of financial transactions that you stick into your financial statements. Integrated reporting is discretionary. It's up to the management what they include and what they choose not to include. Financial is consistent, integrated inconsistent. You just need to look at a set of reports across different companies to realize that. Financial accounting can be audited and verified. Integrated reporting, to a large degree, can't. I'm oversimplifying, of course. Financial accounting is backward-looking insofar as it's based on events that have happened, in order to be recognized. Integrated reporting has no such constraint. It's not just forward-looking. I think it's important. It's also reporting on the state of the business as is and non-financial performance of the business historically. But it's not constrained to being backward-looking. And financial accounting complies with standards, of course, and integrated doesn't, and that's where you get the EY subjective ranking of quality that Mary is using in her paper. And, the need to have that subjective ranking in the first place arises for integrated reporting, but not for financial reporting, because of all these various factors. And then, if you look within integrated reporting, and you look behind the elegant simplicity of there are 6 capitals, you start to realize that the different capitals mean quite different things as well, right? So, not least, the first line here, financial capital is the exact opposite of social capital and natural capital. Social and natural both correspond to assets, and financial is a claim on assets. It's the other side of the balance sheet. Financial capital is constrained to the ownership of net assets. Social capital is by its very nature external to the business. It belongs to society in some abstract sense, right? It's not a corporate asset. And natural capital, to the extent that it's important, typically, it could be on a company's balance sheet, but typically it's somewhere else down the supply chain. And it may or may not be owned by the corporate sector. It may be owned by the public sector. Financial capital is measurable. Social capital, I think, is just inherently ill-defined. We haven't even got to the stage of being able to measure it, I would say. Natural capital is measurable in principle. So there are not, with the exception of carbon, and some other exceptions, we don't really have standards that have developed to measure natural capital, but in principle we could have. Finally, financial is relevant to shareholders. Social capital, I'm not entirely sure who it's relevant for, it's mixed. And natural capital very clearly is relevant both to shareholders and more broadly to stakeholders. So as soon as you start to scratch the surface of integrated reporting, it becomes clear that it's not quite so neat and clean as the high level diagram would seem to suggest. It's also rather vague in the way people talk about it. So this is not EY, this is KPMG. They do, as you probably know, a sort of major global survey of they call it corporate responsibility reporting. You can call it sustainability reporting. You can call it integrated reporting if you like. And they talk about financial stakeholders needing to know the impact that business is having on its environment. That seems right, and that's the kind of language that gets used. But actually, from a shareholder perspective, impact doesn't matter unless it becomes consequential for the shareholders. If it's impact you can get away with, then it's not actually, it's only instrumentally and very indirectly relevant to shareholders' interests. What really matters is not impact, the sort of the output of the IR framework, as it were. It's dependencies, it's the input. So if you're a business that is highly susceptible to the risk of flooding, your shareholders need to know that in order to price your equity, whether or not you cause that flooding in the first place. And if some other business is causing the flooding, but is getting away with it in economic terms, why would it report? So even the language is confused, actually. Okay. So this leads me to ask the question of what IR actually is. So in South Africa, it's mandatory. It seems difficult to make something mandatory when the thing you're making mandatory is inherently vague. I mean, this is not just a problem with integrated reporting, of course. This is a problem generally with strategic reporting. If you're requiring forward-looking reporting, if you're requiring reporting about governance, if you're requiring reporting about things that don't obviously add up into a valuation model, then, and that are business-specific and so on and so forth, then unavoidably you're in a space that's vague. But given that that's the case, mandatory integrated reporting is a very different creature from mandatory financial reporting. And anyway, what's special about it? I think you could argue that the EU has de facto mandatory integrated reporting. You could argue, in fact, the US does through the MD&A. So it's a slightly more difficult case to make. But if you look through the EU has, as you will all know, a non-financial reporting directive. And I've picked out the sort of environmental bits of the non-financial reporting directive, but they look like quite a good description of integrated reporting, actually. So if European companies are mandatorily required to report on their policies, outcomes, risks, impacts, and so on, potential risks of severe impacts and so on, then in essence, in substance, whether they use the label integrated reporting or not, that's sort of what they're doing. Within the UK, which remains a part of the EU for the time being, there's also a requirement for, there's a duty on directors to have regard for social, environmental, and governance factors in running the business. And there's a duty, a statutory duty, to report on those things in the strategic report. So again, you've got actually, in substance, mandatory integrated reporting, whether you call it that or not. Okay, so what is integrated reporting? I think there are two ways to conceptualize it, if you sort of step back from all of this. One way is to say it's a very early version of non-financial accounting standards. So it's not yet at the stage of saying, here's what an accounting standard for carbon looks like, or here's what an accounting standard for water looks like, or here's what an accounting standard for income inequality or something like that looks like. But you can imagine it getting there. And by creating the labels of the different capitals and generating interest in the space, as it were, and generating reporting behavior and practice, you can imagine over time that evolving into something that looks rather like accounting standards, just on the non-financial side. You could also say integrated reporting is just a social convention. It's what you like to think it is. We use the term to mean what we want it to mean. So it's a social construction, essentially, but it's very powerful, I think, in that regard. And I think the vagueness of the framework is, by design, very clever, because it's difficult to disagree with. And you can read into it whatever you choose to read into it, and that in itself enables the evolution of practice, I think. So I think we're seeing a really early stage, sort of nascent practice. Both those two things go hand in hand, and both are very important, I would say. What IR is not, explicitly, is a multi-stakeholder perspective. So this is taken from an IASB management commentary board paper where they use the term wider corporate reporting. And they basically say, look, this is reporting to shareholders, and this is reporting to stakeholders, other than shareholders, and there's an overlap. And the overlap is non-financial reporting from the IASB's point of view. That's the management commentary. It's providing information that happens to be relevant to other stakeholders, but you're only providing it because it's relevant to equity, to investors. What that does, of course, is it ignores the reporting needs of other stakeholders. And it seems to me that the accountability of corporations and the role of accounting for corporations shouldn't, at least in the context of this audience here, shouldn't in principle constrain itself just to thinking about equity investors or other investors, but should think more broadly about the role of accounting in society. So those factors are important and explicitly scoped out of integrated reporting. So let me just closing 2 or 3 more slides just to illustrate the direction of travel and the issues that arise. The question here is what problem in natural capital accounting are we trying to fix, right? So if you think financial accounting is fine, right? You know, we've cracked that one. We've figured out how to do that. We haven't figured out how to deal with the other capitals. So take natural capital as an illustration. What's wrong with accounting? You know, well, what is it that we need to change? What problem are we trying to fix? Well, one problem is that the past is not a good guide to the future. This is true in general for financial accounting. You know, if you have a business that has been successful and the market goes away, technology changes or something, the future is not a good guide to the past. And so you need good reporting on intangible assets and various other things in order to supplement the historical financial accounting. The same is true for natural capital. If you imagine a company that's making good profits by over-exploiting a natural resource, the overall exploitation is not necessarily going to be visible in the accounts, but it will be visible in the profit, right? But the profit's not sustainable. So again, you need information about the organization's dependency on natural capital to supplement the accounts in order to have better information about financial sustainability. The other thing that is a problem here is that financial accounting has a quite narrow boundary scope with respect to natural capital. So if you're drawing upon natural resources very heavily, water, soil, air, whatever it happens to be, and you don't own those things, then impairment losses associated with them are not captured on your balance sheet. And so financial accounting as we know it, as it were, and this closely links to the first point, financial accounting as we know it doesn't extend deeply enough into the supply chain to give enough of a sense of whether we're maintaining natural capital or not. It gives us a sense of whether we're maintaining the financial capital of the entity. not the natural capital of the supply chain. So there's a different perspective to accounting that's needed. The final thing, of course, is natural capital or financial accounting by design doesn't take into consideration negative externalities. So if a large oil company makes large economic profits from the sale of fossil fuel, and the sale of fossil fuel leads to global warming, and the global warming is a cost that's impacted on everybody else, then the world is not in a better place, but the stock market is, and the Exxon Mobil, or whoever it happens to be, is. So financial accounting by design doesn't address that problem, but systems of accounting and accountability more broadly ought to. So is integrated reporting the solution to those particular problems with respect to natural capital? Well, it could be, to a degree. If more developed to be beyond a sort of vague framework, to be a set of standards and metrics, it could address the first two of those problems. To do that, it would need non-accounting expertise. A strange feature of the integrated reporting domain is the dominance of accountants. Actually, knowledge of natural capital and social capital and the other capitals is not knowledge of accounting. Knowledge of accounting is relevant, but that's not the expertise that's needed. The corporate reporting model would need to have a different scope to embrace the supply chain, actually downstream as well as upstream. And integrated reporting as an organization, the IRRC, would need to have much greater institutional presence and regulatory clout, which it doesn't currently have. Final point, integrated reporting is, of course, not the solution to the problem of externalities. Integrated reporting by design is oriented towards the shareholder and doesn't address the problem of corporate impact on the wider world. So the problem of pricing equity investments correctly is not the only problem that accounting should concern itself with, but integrated reporting is narrowly focused in that domain. That's it. Okay.
Thank you, Richard. I started by saying that IR is a multifaceted concept, and you said that it's vague by design. I really like this expression. Now, Brad, we are very eager to learn what are companies doing with this vagueness, what are the opportunities and challenges that they are facing.
Good evening. You've heard a lot of discussion from both Mary and Richard on some of the challenges with the process around integrated reporting, some of the impacts and outcomes, as well as some of the things related to the accounting standards and measurement and things like that. And I'm going to actually take it back a little bit further to look at something, additional challenges with another fundamental sort of underlying factor, the data itself. And so you'll see from the title of my slides, Closing the Trust Gap in Integrated Reporting, the use of the COSO Internal Controls Integrated Framework to build and close, or attempt to at least close, what we're calling the confidence or trust gap between financial and non-financial information. What I'd like you to notice here, you will not see anything in my sort of short bio here. I am not an accountant. I've been working with the accounting profession for the last 22, 23 years, so I know enough to be dangerous in terms of understanding sort of the key strategic issues. I'm not an expert on accounting standards, so I hope none of you will ask me questions about those. But nevertheless, I'm very much focused on some of the more recent key strategic issues facing the profession, particularly focused on the evolution of corporate reporting and disclosure, particularly in the non-financial space. So, starting with CSR and sustainability reporting probably about 8 to 10 years ago, and as that has evolved to ESG, or environmental, social, and governance reporting, and then of course more recently integrated reporting and integrated thinking. So I wanted to take you through a couple of, three sort of basic areas. I first want to give you a little bit of context. I think I'm going to try and avoid any redundancy with some of the remarks that Mary and Richard have made. And then take you through some of the research results. I use the term loosely, in quotes, research. It was more directional information in us talking with a number of large corporates on where are they in this process of applying COSO integrated internal controls framework to their sustainability performance information. And then finally, I'll give you some insight into some of the early observations and recommendations that we had from that process. So a little bit of context. Obviously, the market needs and the information needs for that market are evolving, depending on what type of stakeholder you are. So there are obviously investors, analysts, and other interested stakeholders in wanting to know certain pieces of information as they make decisions to allocate capital or perhaps some other kind of decision. And those needs are evolving. Some of you are aware of Ocean Tomo's research over the last couple of decades in looking at where are indicators of value found, and I think Richard talked a little bit about looking at off the balance sheet. They have increasingly found that I think it's over 84–85% at this point of the value is found off the balance sheet in non-financial measures. So looking at the other 5 capitals that both Mary and Richard have shown you here is where they're finding additional indicators of value and getting a more comprehensive picture of how that organization creates value over the short, medium, and long term. In terms of IR, reporting obviously has evolved to its most advanced state at this point, which is integrated reporting. Both my colleagues here on the panel have talked about the multi-capital model, how it measures the changes in the stocks and flows of those. You're really looking at impacts and outcomes on the other end, and those are increasingly challenging to measure. We also want to make sure that just because they capture the information doesn't mean it's relevant, so limiting the disclosures to that which is material, and we'll talk a little bit about materiality as well in the Q&A session. And really, does it tell a unique value creation story for that organization? We also see technologies evolving significantly. Corporate reporting and disclosures are evolving to better reflect how a company or organization is performing and creating value over the longer term. And the way, apologize, got ahead of myself. The way to enable and enhance, these technologies are enabling and enhancing data authoring, gathering, validation, and more importantly, the analytics function. Deloitte recently came out with a study on predicting some of the upcoming technology trends and trends facing business, and one of the things that they talked about was this concept of no-collar jobs. And what you're seeing, robotics sitting shoulder to shoulder with the humans in their roles, various roles, including in accounting and finance, and what will be interesting to see is how that plays out, particularly in the accounting function for integrated reporting. So the next thing that really is what I want to focus on is how data is evolving. And in many ways, how it's authored or created, both in structured and unstructured forms, data governance and having the right strategies and policies in place to ensure that not only do you link information back to its original source, but that lineage and integrity of that information is maintained, how information is consumed as we get to more advanced analytics. It's no longer just about predictive analytics, but prescriptive analytics that actually shows you the choice and the path to be made. You target a goal and you let the data direct you to that goal. And then finally, what kind of insight are you getting from the information? You're interpreting those advanced analytics to understand what does it mean, what's the impact on our strategy as an organization. The mix of information is evolving. Obviously, when you look at the tip of the iceberg and what shows, the more commonly used sets of information are financial in nature. But as the Ocean Tomo research has shown and experience has shown over the last decade, certainly, more and more of the information is what I'll say lies beneath the rest of the iceberg. That tells the rest of the story and helps to unlock perhaps the hidden value creation drivers in the non-financial information in that mix of information. So the next slide, I'm not going to go through all of the points on this particular slide on your left-hand side, but I wanted to sort of have you think about and reflect on the excerpt from Dr. Jean Rogers' quote. So for those of you who don't know who she is, she is the founder of the Sustainability Accounting Standards Board, which is in the US, and she is, until recently, she was the past chair of the SASB Foundation. And what she said in this quote is that sustainability issues are in fact material to business, of interest to investors, providers of capital, and germane to management accountants. And she's been on the record of making this statement a couple of times. And I think the important thing here is to know, and as Richard just pointed out as well, non-financial information and sustainability performance information is a must for accountants. They must understand this domain. They must understand how to use this information, how to validate it, how to analyze it, how to gain insight from it. So in terms of the trust gap that I talked about that was sort of the basis for our research paper, you know, there are many challenges. That gap I see currently as widening because the market is extremely complex. There are a number of factors at play, and they're all moving very, very quickly. So some of those challenges, I think you heard some of them here, you know, lack of a uniform global standard on reporting sustainability performance information. There's what I liken to a patchwork quilt of frameworks and standards out there for companies to work with. Sometimes they like aspects of several of them. So I think it's challenging for them to understand which framework or standard should I be using for my business. There's a lack of clear oversight authority. You know, is there one entity that oversees the quality and consistency of those standards that are used by the marketplace? There's a lack of effective controls, as we found out and validated in our paper, or lack of a use of effective internal controls around sustainability performance information. But there are also opportunities to help close that gap. And that is, you know, at a high level, we want to build greater confidence in sustainability information and reach a level of assurance, whether you want to look at it in the official accounting-related sense or definition, or perhaps in the looser sense, where we're building confidence and trust in that information, and that users look at sustainability performance information on the same level as they will financial information. We want to bring consistency to the related standards for disclosure. We want to enhance data governance around sustainability information. And importantly, we want to help organizations design and implement more effective internal controls. Investors are making their voices heard and calling for action. So some of you have seen from Larry Fink, the CEO of BlackRock, has issued a couple of letters to the marketplace, putting them on notice. And they're looking for organizations. They will not be investing in organizations that don't make a positive contribution to society. And they're focusing on all stakeholders, not just shareholders, as key drivers and key audiences to work with. But importantly, they need trust in the information, the sustainability and non-financial information that goes hand in hand with that financial data. And that's where we're out of equilibrium and balance. So, for those of you that are not aware of the paper, I co-authored a paper with, perhaps you recognize the gentleman on the left, Robert Herz, who is a former chair of the FASB and is also a member of the SASB Foundation Board. Jeff Thompson on the right is the CEO of the Institute of Management Accountants. He is the representative for the IMA to the IARC Council. He's a member of the US Working Group, and he's also a longstanding member of the COSO board. And so we developed this paper called Leveraging the COSO Internal Control Integrated Framework to Improve Confidence in Sustainability Performance Data as a conversation starter. We wanted to stimulate dialogue in the communities that we're talking to about this issue because we surmised that this is not a widely practiced activity, using and designing effective internal controls around non-financial information. And so we set out to talk to a large number of multinationals and very large corporates to find out, what are you doing in this space? And using the COSO internal controls framework as a guide for that discussion. The unfortunate thing, perhaps, is that because of SOX 404 regulations in the US, the COSO internal controls framework was somewhat pigeonholed as a framework for financial controlling, when in fact it was always intended for all types of information, including the non-financial disclosures. But through the last couple of decades and the requirements in the US market, it has unfortunately been misperceived and misused. Not misused, but not fully used to its advantage over non-financial information. So we wanted to engage some of the companies that we talked to in a discussion around that. We opened our paper with this statement: effective internal controls are good for business. And it's quite a simple statement, but I think impactful. And it really was part of our effort to show that internal controls have value beyond compliance and external financial reporting. Effective internal controls can ultimately help organizations grow on a sustained basis, leveraging the confidence, integrity in all types of information. So again, not just financial, but also the sustainability performance information. And as I mentioned before, when the Internal Controls Integrated Framework was recently updated in 2013 by the COSO organization, and they indicated at that time that they had intentionally expanded the financial reporting objectives to include more evolved forms of reporting, which includes non-financial and sustainability reporting, and ultimately today, integrated reporting. So for those of you that are not familiar with the cube, the COSO cube as we call it, that's on the left in the diagram here. I'm not going to go through all of it, but essentially across the front of the cube are the 5 components. Across the top of the cube are the reporting objectives. And then on the side are the structures. You can kind of look at it as the levels going through the entities that you're talking about, from a high level down to transactional level. Associated with each of those components, there are 17 principles in total that we reviewed, or reviewed most of them, in our research for this paper. I'm going to actually give you some examples of use cases and share the sort of the highlights of some of the organizations we spoke to. Hopefully you'll recognize some of the names. The first organization we spoke to is Novo Nordisk. How many of you are familiar with Novo Nordisk? You've heard of the company? Okay, they're a very large pharmaceutical company based in Denmark. They have about 16 billion in sales. And Novo Nordisk has been what I would call a responsible corporate citizen for much longer than when we've all been talking about being responsible corporate citizens. They've been doing this for a very long time. And they did it for the right reasons, because they knew it was the right thing to do, not because they had a mandate or any kind of requirement to do so. So they began, as we talked to them, they began using triple bottom line in 2004, and then began using the COSO framework in 2008. And so we talked about how did you implement this? What were the challenges? What were some of the obstacles? And so one of the first things they did was they created a cross-functional team with representatives from a number of functions and roles and areas. So when you think about a typical organization has silos, they recognize that they have to pull representatives and input from across those silos. They also then found that they applied that team looked at each of those components in the COSO framework, the 5 that I talked about on the front face, and they applied them to their triple bottom line objectives and found that this was a very cost-effective way for them to begin the process of implementing effective internal controls on the non-financial side of the house. They also involved their internal SOX reporting experts, who already have obviously very detailed knowledge around financial reporting controls, and they talked to them about how they might leverage that over to the non-financial side. And they found that to be, again, a very efficient, streamlined process for them, and that they ultimately created a set of sustainability controls at both the entity and the transaction level. Some of them are manual, some of them are automated, some of them are preventive, and some of them were detective. And so overall, they are probably one of the earliest leaders that's gone the furthest in looking at the use of effective internal controls around non-financial information. Next that we looked at was, as an example I'm going to share with you, is under the control environment component, Principle 3, which primarily focuses on accountability and oversight. And it helps an organization establish clear structures, authorities, and responsibilities with proper senior management and board oversight. And the example that I'm going to share with you is CalSTRS, which is a very large teachers' retirement fund in the state of California. It is the 11th largest, actually. So they have $198 billion in their portfolio. And one of the things that they did was they leveraged, similar to Novo Nordisk, leveraged their existing processes and standards to support their sustainability reporting objectives. To help ensure that they achieve those objectives, they are developing content that's leveraging the data that has been prepared for and vetted through their existing rigorous quality control processes at the senior management and board level. So if they're already preparing reports and information that have to be validated, vetted, and approved for the highest levels of presentation at their board level and their senior management level, they're applying that same information and that same process to their sustainability disclosures internally. So they took a very familiar, tested environment and its proven processes and controls and leveraged them over to their sustainability data. So for them, it wasn't perceived as a large jump. So they weren't reinventing. They looked at what they already do with their financial controls and leveraged as much of that over as possible to the non-financial information. Next, I'm going to talk a little bit about Principle 8, which is under the risk assessment component. And it focuses pretty much on fraud risk. And so it guides an organization in segregating duties, which is really important to be able to tell if something is going on internally with potential fraud. It's segregating duties for collecting, validating, and reporting information. And it's based on a strong culture for them of open, transparent communications. It also recommends a regular assessment of fraud risk at some degree of frequency. So the case study that we focused on here was Pirelli. The company's comprehensive annual report, they already produce somewhat of an integrated report. It integrates their financial and sustainability information, and it clearly tries to link the two as much as possible in that disclosure, in that communication. So they collect and monitor financial and sustainability data, and they have a comprehensive internal audit program in which all of their sites are audited every 3 years. Sustainability information is included within that audit. And in fact, they engage a third-party auditor for assurance of their ESG or environmental, social, and governance information contained in their integrated annual report. Their suppliers are also subject to third-party sustainability audits. So they're looking at their entire supply chain, not just what they're responsible for, but what's upstream and downstream from them. They established a board-level committee to oversee sustainability. So at the highest levels of governance, they established a committee that is focused solely on this very important matter for their business. And then they also developed, they've really gone far in what they've done so far. They developed a proprietary IT system that's called CSRDM, or Corporate Social Responsibility Data Management. And that was developed to consolidate all of their environmental and social performance data from all of the Pirelli business units worldwide. So collectively, these efforts help Pirelli to monitor various risks, including the potential for fraud related to some of the sustainability information that's collected within their supply chain, not just within their organization. And I think that's the key distinction. Now I'm gonna skip over a couple of slides because I want to make sure we have time for questions. So in terms of some of our recommendations, so the first slide here, so it's what probably looks like a very simple and perhaps familiar process to you. What we found in talking even to the largest companies, although there was some very strong progress and experience from some of the providers I presented to you in the case studies, this is a very nascent process. It is not very widely practiced yet. And I think there is a lot of education and awareness building to be had, and I think underscoring a lot of the challenges that Richard and Mary talked about, this is yet another layer to the challenge, and companies need to see examples. So one of the things that we're happy to do is publish some of these use cases in the paper. So I encourage you, if you have not downloaded the paper, you can look for it on the Institute of Management Accountants website, and I encourage you to go through that and see all the other cases. There are a number of them. While we recognize that there may be many of these early examples, as you see in the case studies, we also think that the glass is 10% full. There's a lot of progress to be made. And many of the examples we shared here in the paper are more ad hoc, and that's okay, because this is an early stage in the journey. There are going to be different paces and different speeds at which companies take that journey. And it's an okay thing to have sort of an ad hoc, try something out here and see how that works. At a high level, we're recommending a very familiar looking approach, as you see here with the 4 boxes. and as a starting point to establish effective controls over sustainability performance information. So obviously, to gain consistency and agreement on what are the objectives around sustainability performance information, you obviously have to layer in an assessment of what the key risks are, particularly if they relate to anything material. If you're a beverage manufacturer and water is in your supply chain, you can bet that any risk to that water supply, integrity of that water supply, is a material risk to that organization. Obviously, then identify the appropriate control activities. Again, leverage what's being done with financial controls to the extent it can be brought over to your non-financial information. And then, of course, to always be evaluating effectiveness and make modifications as that process moves forward. In terms of some of the benefits, these are just, I'm not going to go through all of these, but these are just a few, such as integrating sustainability data into existing reporting systems is probably a nice efficiency and internal benefit for the organization. They have to also think about how they're going to leverage technology in the process. So I had my opening slide that talked about the new sophisticated enabling technologies. One of those is also XBRL, which is structured data language, which I'm sure some of you in this room know all too well. And then how to be timely in the data collection and reporting. It's no use to the marketplace to have old information. They want to make decisions quickly. They want information that's current. They want information that is reliable and usable. How to document the processes around the controls, and then what types of policies should be established in order to ensure data quality through a strong data governance strategy and approach. So some of our key takeaways from the market research. And again, I'm not going to cover all of these, but summarize them at a high level. An important one is to start early or start now. This is a journey, and it will take time to get it right. But keep in mind that the stakeholders who want this data now, and they need to trust it, so there is some pressure, so don't take too long. Leverage what you already know and do around financial controls and monitoring to the extent it's possible to carry it over. And definitely use a cross-functional team to help guide the process, including leveraging your existing internal experts on financial processes and financial controls. So finally, a few thoughts on some additional research needs, since I wanted to take advantage of being in the same room with a number of academics from around the world. There are a number of things that would benefit from research on this topic, and I've listed a couple of here. Current and emerging practices around controls and monitoring of non-financial or sustainability information. I'm not sure that there's been a tremendous amount of research done on that. We obviously just scratched the surface with what we did, which was never intended to be a scientific or quantitative study. But I think further, deeper research into how commonly used are some of these controls and practices today would be ideal information and give us more insight, and also share examples. And the issue of assurance that was also brought up by our panel members. When will we achieve and how will we achieve, perhaps if we ever achieve, the same level of assurance around non-financial information as with financial disclosures? And then interesting correlations between sustainability data quality, performance results, and value creation. And then finally, other important drivers of trust that are closely linked to the quality and reliability of sustainability information. Thank you.
Thank you so much, Brad, for sharing your experience with us. I think that we can now open the floor for questions.
Just a quick question. With the Paris Accord and the Financial Stability Board, which works closely with the G20, the UN is now putting together a universal framework for sustainability reporting. They've already created a framework for human rights that companies can start using. again, it's this concept of creating a global report that can be used by all companies around the world. Do you think that those types of efforts are going to stimulate the further disclosure of this information by companies by creating these global reports that can be used?
David, can you repeat the first part? The echo is actually very difficult to hear you.
Sure.
Of the question.
Efforts to create global reports that companies can use to disclose, will that increase the utilization of this data by the capital markets?
I think the challenge for users or consumers of information, if they don't know that it's prepared against a consistent standard, are they comparing apples to apples or apples to oranges? And if it calls into question the quality and reliability of the information, I would think, certain stakeholders like investors may be skeptical, and they have, enough of a trust gap or a confidence gap in the information there to, are they really trusting their decision-making and the insight that they get from that data? Can they get insight from that information? The financial information has a much longer history and reliability and standards and oversight. That's probably not a question. So I think when you're looking at both sets of information, especially when it's fully and properly integrated in a disclosure, it may be somewhat challenging for them, at least in these earlier years. I think as adoption goes forward and we see some of these challenges resolved with uniform standards, for example, and better use of controls so that the outputs in those external disclosures, and even more importantly for internal management to look at their own reports, can they trust their numbers? Can they trust the narrative? Can they trust the information so that they can make the right sort of strategic business decisions? I think it's still at a stage where, that's questionable. My perspective, at least.
Thank you. Laura Girella from the International Integrated Reporting Council. First of all, to Bocconi University for organizing this symposium, and by seeing the number of people in the room, I think that clearly there is a growing interest in this topic. Talking about achievements of the IRC over the years, I think that is quite remarkable to say that at the moment there are 1,600 companies that are adopting integrated reporting worldwide. By saying this, I'm not saying that the concept of integrated reporting and the tool of integrated reporting is perfect. There are still some criticalities that we are trying to address. But I would just be a little bit cautious in associating too much integrated reporting with sustainability reporting, because if we just look at the 6 capitals, there are 3 capitals that are clearly of intangible nature. There is one which is related to natural capital, so clearly it is related to sustainability, and then there is manufacturing and financial, because most of the time there is the risk to say that integrated reporting is a sort of advanced form of sustainability reporting, which is not. It's about value creation in the short, medium, and long term. This could include sustainability aspect, but it could also not include sustainability aspects. I mean, this is up to the companies to understand which are the capitals that they are leveraging on in order to create value. And also as just an initiative and a collaboration that has started since last year is to collaborate with the ISB in relation to the review of the management commentary practice statement. So this is just to say that, yes, there are sustainability aspects included in integrated reporting, but integrated reporting is not only about sustainability, it's about value creation. Then I agree with the fact that it is then difficult to define what is value creation and what is value, and that is for sure one of the issues that we are going to address over the next few years. Thank you.
Can you hear me? Yeah? So your point is that integrated reporting is not the same thing as sustainability reporting. And I think the answer to that question would depend upon how you define sustainability reporting, which is a woefully ill-defined term. So for some people, it means precisely as you described, it means value creation, it means the sustainability of financial performance. For other people, it means reporting to stakeholders on environmental performance that is incidental with and in many ways in conflict with financial performance. So sustainability is incredibly vague as a term. So depending on how you're locating it, I agree with you entirely, or disagree.
Hi, thank you for your presentations. See, when you think of financial accounting, the standards tell us how to measure, and then we can report reliably. Aren't we putting the cart before the horse here by not really talking about how we measure the non-financial value that organizations create? We're trying to report on something without actually talking about how we actually measure the value. There's a difference between reporting and measurement. Financial accounting works because we know how to measure revenue and costs, by and large. Therefore, we can report reliably. So I just want to understand whether there's any work being done on actually measuring the non-financial value.
So the question is about measurement, and I think so. And you were saying, look, in financial reporting, we have measures of revenue and cost. Notice we don't have measures of equity value in financial reporting, in the same way as we don't in integrated reporting have measures of value creation. We have measures, in principle, of inputs, things that contribute to understanding value creation. So the integrated reporting framework itself is silent on metrics. Other frameworks are not. I mean, we've had reference to SASB and GRI and so on. It depends which domain you're in. If you look at greenhouse gas reporting, there's a very well-established protocol for measurement. In other areas, there's nothing. So it's a very sort of emerging and early stage space, but clearly there will be growth in standardized measurement over time. If that answers your question, I'm not sure.
Roger Simnett here from the University of New South Wales. I'm just trying to get the context of the criticism here, Richard, and also some comments from Mary. The IARC never really got into the measurement and disclosure elements. It was always left to others to do the measurement and disclosure and then borrow off those particular measurement and disclosure frameworks. So it was really a high-level conceptual framework which was going to drive. Are you looking for them to do something in the measurement and disclosure of all these other capitals when there are so many initiatives in that field already? And I'd also like to work out whether the criticism is around, is it around the integrated reporting principles or is it around the brand? I mean, I know IARC is trying to sell a brand, but are the principles also up for criticism?
We're having real trouble hearing some of the questions, unfortunately, the echoes that are going on up here. So we got bits of that, but it was like listening to a mobile signal that didn't quite work, unfortunately.
Let me try. So, Roger, were you asking whether the criticism around integrated reporting relates to the brand integrated reporting, or whether what integrating reporting is trying to achieve?
Yes, that was one of them. And the other was around the fact that the Integrated Reporting Council never really tried to get into the measurement and disclosure frameworks. It was basically just describing other frameworks which was there. And it seems like there is a desire coming for the IARC to do something in the area of measurement and disclosure. Have I got that right?
I don't know whether the IARC is looking at minimum disclosures, so I don't have the expertise to answer that question. I think part of the problem is that we're accountants and we're used to having standards. And so we believe they're important to have comparability and these sorts of things that we have now in financial reports. And that's not there for integrated reporting, whether it's not there yet or never will be there. I don't really know what the plan is, but I think that's what makes a lot of accountants uneasy about the integrated reporting when they first think about it.
And if I could add a couple thoughts to that. The integrated reporting framework is not a prescriptive framework for measuring specific things. It's principles, obviously, and it's designed to, or at least it does work with other frameworks that include, whether it's GRI, SASB, others, CDP, that have actual measures or metrics that they recommend an organization include in their disclosures if they're relevant and if they're material and decision useful. The other initiative that you may or may not know that's occurring at the moment is there's an organization that sits under the IRC Secretariat called the Corporate Reporting Dialogue that involves the IASB, CDP, GRI, SASB, a number of organizations and IRC to look at aligning. I won't necessarily say harmonizing, because that can be interpreted in a number of ways as well, but aligning at least the frameworks and the information that they include, because they recognize that the market does have some confusion. But I think to Mary's point, I'm not sure we have a crystal ball and can predict if the IRC would go that far to recommend specific measures. I don't believe that they are intending to do so, but
I think there is a sense in which they don't need to, actually. If you think about financial reporting and reporting, just to illustrate, reporting pension obligations, the IASB doesn't take the view that it should have in-house actuarial expertise, as it were. It's happy to say there is a role for actuaries in providing measurement as part of a financial reporting system. And it seems to me there's an analogy with non-financial reporting, especially because there's such disparate areas of expertise. So to be able to say CDP or WBCSD has the expertise in measuring, coming up with metrics for carbon, that's fine. The IRC doesn't need to duplicate that effort, I think.
I think it's also difficult to come up with precise standards or rules for non-financial information when what you're trying to do is convey what's going on inside the company, which is likely to be different company to company, industry to industry. I remember there was the Jenkins Committee in the United States many years ago tried to look at non-financial measures. And that's the roadblock they ran up against, is that there were so many different ways to have non-financial measures that it was almost impossible to say, you should be using this one, you should be measuring things this way. They said, wait a second, the objective of this is not to have everybody have the same measure, it's to say, what are the measures by which we manage the company in those days? And so I think of the framework as being like the conceptual framework at the ISB, and then we have standards, and then we have implementation guidance and rules, or the principles in the standards maybe. And it may be you can go to the next level, you have a bit more meat on the bones, if you will. But I don't think we're ever going to get. It'd be very, very difficult, I would think, to get to the level of detailed requirements as we do for financial reporting. But that's my very cloudy crystal ball.
And I'd like to add one other facet to what Mary just said. I think, sometimes when you think about investor needs, they're probably looking at more than one organization, and they're probably looking at more than one set of information to analyze. So there's kind of a struggle, the right balance between you want to compare information, and in order to compare how it was calculated or determined or against what standard, what units of measure, any number of factors, because otherwise your comparison has a lot of caveats and is somewhat meaningless if they are in fact apples and oranges. But at the same time, IRC certainly recognized with its framework that they wanted organizations to be able to tell their unique value creation story. So they have to have the flexibility to do so. So how do you strike that balance between, you don't want cookie cutter reports, integrated reports that all sort of look the same with the same metrics and same information covered in each, but at the same time, investors need to know that they can compare if they're performing analysis or another stakeholder is comparing organizations. So I think that challenge has not been solved.
Thank you. Stefano Zambon, University of Ferrara. Thank you, the panelists. Thank you, of course, EAA for organizing that. Of course, the integrated reporting is a fascinating topic, but a few things. Integrated reporting, clearly, if you compare to financial reporting, it's like to compare an adult or an old man with a baby, basically. So to some extent, it's a little bit unfair. I think we need to keep up a little bit more open. Clearly, in research terms, there are many opportunities. I saw incredible number of papers, a very short time coming out. So for researchers, it's really like a paradise nowadays. Clearly, research methodologies will be important. And maybe we should follow different research methodologies, not necessarily only the statistical base, but maybe we need case studies to understand more the internal benefits. Another point is that what I like to stress is the sustainability aspect is one of the aspects. But remember there is inside, please, there are lots of intangibles. So from a conceptual viewpoint, integrated reporting expresses a new theory of the firm, so to speak, a multi-capital theory of the firm. And reporters and accountants are somehow called upon answering to this. Is there are not lots of non-transaction data that compose the integrated reporting. So clearly there's a large scope for research, for invention, but I will also encourage people to look at integrated reporting in a positive way, because this is a great innovation, I think, in our field. And it's easy to kill innovations, we know also in companies, because they are only babies for the time being. So in sustainability reporting, clearly I understand, Richard, your point, but on the other hand, sustainability also in the reporting, you've seen probably in the directive nowadays, is about more social environmental aspects and rights and respect of various types of rights. And integrated reporting clearly has something like that. In fact, in Italy, for instance, there are important companies like Generali, like Fideuram, like many others, Unipol, that produce integrated reporting, and inside they have the requirements of the EU directives on non-financial. So also this kind of somehow kind of merge between the two is also an interesting aspect to be researched upon. Just a comment. Thank you.
So we have time for one additional question.
Charles de Villiers, the University of Auckland, New Zealand. I have a question for Mary regarding your paper. Integrated reporting quality has a voluntary aspect to it, because even though they have to produce an integrated report, they can choose to what extent they follow the guidelines. So, given that, how do we interpret your results? Could all firms, any firm that produce a good quality integrated report, garner these good economic consequences? Or is it only a certain type of firm? Is it certain types of firms who could foresee the economic benefits, who chose to do the better quality integrated reports?
So our paper doesn't establish causality, but we address these issues in the paper because we control for a lot of things that quality of other financial reporting, CSR reports. That's what the control variables are for, and then we do lead lag. It's all explained in the paper. So we do the best we can to make sure that it's not that the good companies are doing high quality integrated reports and high quality everything else, and they're the ones with the good capital market benefits. We do our best to control for those things.
So I think we leave this symposium with some answers, a lot of questions, which is reassuring because we have a lot of work in the next months to come. So let me thank again our panelists, Mary, Richard, and Brad. Thanks a lot for sharing your insights with us. Thank you for your questions, and I hope you will be here at 7 for the celebration of the 40th anniversary of the European Accounting Association. Thanks a lot.